Welcome back to Investing Talk Podcast.
Today we're looking at Cameco. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We really have to start, I think, with the foundation, the balance sheet. Because before we get into like uranium prices or stock charts, you got to know if the company itself is solid. And Cameco's financials, they're pretty exceptional.
Right. Because when you look at commodity companies, miners especially, you often brace yourself for, well, a lot of debt, right? All that capital spending. Does Cameco look like that?
No, it's fundamentally different, actually. People call it a fortress balance sheet, and honestly, it fits. The big number everyone points to is the debt-to-equity ratio. It's super low, just 0.15.
Okay, 0.15. So just to break that down for you listening, that basically means for every dollar of assets they own, they owe maybe 15 cents to lenders. That's minimal risk, especially for a resource company this big.
Minimal risk is exactly the term. And it's not just debt. Their liquidity is also great. You look at the current ratio, it's 3.0.
Yeah.
So they've got, 3 times the liquid assets they need to cover short-term bills. They can fund growth, handle price swings. They're financially pretty much bulletproof.
Okay, so that's the safety aspect, bulletproof.
Mm-hmm.
But safety doesn't always mean growth, which is what really moves the stock price. Are they actually generating strong returns on top of this solid base?
Oh, absolutely. The recent growth on the top line, the revenue, is kind of astounding. Last period reported revenue hit $2.24 billion. That translates to a huge 46.7% year-over-year quarterly growth. This isn't some small uptick. It's real strong demand hitting their books. Big time.
Wow, okay. 46% growth and almost no financial risk. That sounds, well, almost too good to be true. But in commodities, that only works if you've got some kind of competitive advantage, a moat, right? To stop others from just jumping in. What's Cameco's edge here?
It's their structure. It's unique. It's sophisticated. It's this vertical integration they have. They're not just one thing. They run 3 segments that work together: uranium, fuel services, and the really important one, Westinghouse.
Westinghouse. Yeah, that often gets a bit lost when people just talk about Cameco as a uranium miner. How does that piece change their whole competitive setup?
It changes pretty much everything. See, most uranium miners, they're just exposed to the spot price of yellowcake, the raw stuff, which can be really volatile. Cameco, though, because they're integrated, they control more of the cycle mining, milling, conversion services. They sign those crucial long-term contracts.
So they manage the supply chain better, but Westinghouse, that takes them even further from just the raw commodity price swings.
Exactly. Westinghouse is like a nuclear reactor technology provider, an OEM original equipment manufacturer, plus licensing, plus services. Think of it like this. Cameco doesn't just sell the fuel, the uranium. Through Westinghouse, they also sell the engine, the reactor tech, and the long-term contracts to keep it running. That revenue stream from equipment and services, it's much more stable, high-margin stuff.
That's the moat then. So even if uranium prices dip for a bit, they still have Westinghouse kicking in steady revenue. That position in the capital equipment side of nuclear power, yeah, that's a huge edge over smaller miners who just dig stuff up.
Precisely. And that whole integrated setup is why they're positioned so well for this big global shift we're seeing towards nuclear power as part of decarbonization.
Okay, established.
Yeah.
Financially strong, structurally advantaged. But what happens when a story like this hits the market? How are traders and investors actually, reacting? Let's look at the technicals.
Yeah, the technical picture, it's definitely bullish.
Yeah.
Which makes sense given the fundamentals we just talked about. The stock's trading around, $102.21 right now. It's close to its 52-week high, which is about $110.16. But the chart shows that classic bullish pattern: higher lows, higher highs, consistently.
And I'm seeing it's way above its main moving averages, too. That usually means any dips are getting bought up pretty fast.
Absolutely. It's well clear of the 50-day simple moving average, the SMA, which is down near $84.82. And the 200-day, the real long-term trend line, that's way down at $63.54. So the trend is strong. It's intact. And remember that big jump recently?
Oh, yeah, that 17% day. That must have caught some attention.
It definitely did. October 28th, 2025, a huge 17.42% surge that seemed purely driven by good news around, uranium supply and demand tightening up. And the momentum indicator, the RSI, the 14-day relative strength index, it's sitting around a 58.92, so it's not like wildly overbought, but it confirms that strong upward push.
Okay, now let's shift to sentiment, because this is often where things get interesting, where you might find an opportunity if you look closely.
Right. Analysts, they seem to love Cameco. The consensus is a strong buy pretty much across the board. Average price target is $111.25. That suggests, maybe an 8.85% upside from where we are now. But what's really telling is you basically can't find any sell ratings. None.
And the big money, the institutions, they've clearly bought in already, judging by the ownership level.
Well, it's huge. Institutional ownership is up at 70.21%. So yeah, the major players are heavily invested here.
So you've got this clear technical momentum, almost unanimous analyst support. But here's where it gets tricky, maybe. The broader market mood seems a bit more cautious.
That's the divergence, exactly. While Cameco itself looks bullish, the wider fear and greed index, it's down at 39. That signals fear in the overall stock market.
Yeah.
And that contrast is interesting. It often suggests that maybe the market is overlooking the real potential in strong companies like Cameco just because of the general anxiety about, other stuff that has nothing to do with nuclear power.
Okay, that sets things up nicely. Great company fundamentals, big structural tailwinds, institutions are on board. What are the immediate things, the catalysts, that could push the stock through that $110 resistance?
Well, the absolute most critical near-term thing is the Q3 2025 earnings release. It's scheduled for November 5th, 2025, so just days away. Given that incredible 46.7% revenue growth we talk about, investors are really, really hoping for expecting maybe management to raise their guidance for the future. That's the one event that could trigger a really significant re-rating of the stock almost overnight.
And outside of the company's own report, what about the sector itself? Are those underlying supply-demand dynamics still tightening, still supportive?
Yeah, they seem to be tightening quite a bit. You're seeing major governments internationally committing more strongly to nuclear energy. That gives you this decades-long structural demand. Think about France, the UK, the US, clear policy supporting new reactors. That means guaranteed long-term demand for what Cameco sells, both the fuel and the services.
And we should probably also mention those scheduled dates for institutional flows. Sometimes those can move a stock regardless of news.
Exactly. There are two key ones coming up soon. First, November 14th is the Institutional Holdings Report deadline, the 13F filings. That shows us who bought and sold last quarter. Then, December 18th is the ETF quarterly rebalancing. That affects big indexes like GDX for miners and URA, the main uranium ETF. Cameco's a big piece of both, so rebalancing forces buying or selling.
Okay, powerful tailwinds, immediate catalysts. Sounds great. But now, we absolutely have to talk about the flip side. What's the biggest worry for anyone looking at this stock right now? Why isn't this just a slam dunk?
The single biggest risk, it's valuation. Plain and simple. The market seems to have priced in not just the next year or two of growth, but maybe like 5 to 7 years of perfect execution already.
Right, and that's where you see those eye-watering numbers. Let's talk about that PE ratio.
Yeah, the trailing price to earnings ratio, it's incredibly high, 113.84. And even looking forward, the forward PE, based on analyst estimates, is still way up there at 82.90. So you're paying over 113 times the company's current earnings for one share.
Hold on, 113 times earnings. That's huge. Even for a fast-growing tech company, let alone something in the commodity space. Doesn't that make the stock extremely fragile? If everyone loves it this much and the price reflects perfection, shouldn't we be really careful?
We absolutely should be. That extreme valuation makes it super vulnerable if anything disappoints, especially on that November 5th earnings call. The market isn't just hoping for good news, it's demanding it. Flawless execution is priced in.
So what's the potential downside if they do miss those high hopes? Or maybe just offer cautious guidance?
Well, the analysts suggest that even a small miss, or management sounding hesitant about the future, that could easily knock 10%, maybe 15% off the stock price, just because that multiple can't handle anything less than perfect.
And speaking of guidance, there's also this guidance uncertainty thing people mention. Management seems a bit reluctant to give super clear forecasts for all of 2025. Why might that be?
Yeah, that lack of clarity does raise some questions about how well they can see into 2026.
Yeah.
I mean, yes, they have great long-term contracts, but that hesitation might suggest some internal caution, maybe about execution challenges, maybe near-term costs. And that lack of clear visibility might be holding back some institutions who really value predictability.
And lastly, even with Westinghouse providing stability, it's still tied to the commodity cycle and the broader market, right? It can't completely escape that.
That's correct. It has an above-market beta, 1.18. Beta just measures how sensitive a stock is to the overall market movements. So a beta of 1.18 means if the S&P 500 drops, say, 10%, Cameco is statistically likely to drop even more, maybe closer to 11.8%, it tends to amplify the market swings, both up and down.
Okay, so this is the core issue we've been circling. You've got this incredible financial strength, this great structural moat, clashing head-on with a really stretched valuation that demands perfection. So pulling it all together, what's the final call?
When we weigh everything, the Fortress balance sheet, that 46.7% growth, the moat, the near-term catalysts against that PE of 113, our final take is still strongly bullish. We'd rate it, say, an 8.5 out of 10.
An 8.5, that's high, especially with that valuation risk. So you're really betting on that long-term, multi-decade story, that this is more than just a cyclical miner.
Exactly. It feels more like a necessary utility play almost, wrapped in a miner's clothing. The company combines that amazing financial strength, almost no debt, with really strong immediate reasons to buy, like the November 5th earnings. And it's all riding this huge wave of the global energy transition. They're the leader in a commodity that's becoming strategically essential.
Okay, so let's break that down for different approaches. If you're a short-term trader looking at maybe days or weeks, what's the focus right now?
For short-term folks, it's all about two things: that November 5th earnings report and whether the stock can decisively break and hold above that old resistance level, the 52-week high, near $110.16. A strong break above $110 after positive earnings, that could signal a quick move higher.
And for the long-term investor, someone who wants to own that structural growth story, that competitive moat, for years.
For them, these current levels could still be seen as attractive entry points, thinking 3 to 5 years out. The high PE today matters less if you believe they'll capture a huge share of a growing market over the long haul.
But what if that valuation risk does make someone pause at these levels, even for the long term? Is there a better spot to maybe wait for, an accumulation zone?
Yes, if you look at the technical support levels and just psychological round numbers, the analysis suggests maybe looking to accumulate if the stock dips back towards the $95 to $100 range. That would offer a better margin of safety, while still positioning you for that long-term upside from the structural tailwinds. Ultimately, this situation really asks whether the market's generalized fear, reflected by that index at 39, or the underlying company-specific momentum, which we see in the strong technicals and the massive revenue growth, is the better predictor of the immediate future, especially with such a pivotal earnings report scheduled for next week.